To help paint a picture of why we think a well-designed stock portfolio should include some gold exposure, let's just recap how Toron sets its sector allocations and selects stocks individually within those sectors. We consider the sector's long-term track record of generating earnings growth and generating cash flow per share growth and balance that track record with where the sector happens to be valued as a whole. We don't want to overpay for those positive attributes of cash flow and earnings growth. When it comes to stock-specific selection, we prize management teams that have a good long-term track record of building their business and in demonstrating the quality of their earnings and the reliability and robustness of their cash flows by returning a large proportion of those earnings and cash flows to shareholders, usually in the form of dividends or share buybacks. With that framework in mind, it is perfectly legitimate to ask why we'd bother investing in gold at all. Because as most long-term investors will appreciate, gold stocks have an absolutely horrific track record in covering their costs of capital over the long term, and rather than engage in buybacks or dividends, most gold companies are far more likely to degrade their own paper by continuously issuing stock, to habitually overpay for acquisitions. So it's not all sweetness and light in the gold sector. From our perspective, gold's benefits outweigh those two serious drawbacks. First and foremost, gold is negatively correlated with equities, and what that means in very basic terms is that gold consistently zigs when equities zag, and vice versa. And from a portfolio diversification, portfolio construction vantage point, that is very much the holy grail in terms of what you want to try and achieve to reduce the medium-term volatility of the investing process. The second and equally as important benefit of gold investing is that as part of Toron's mandate of managing funds for high net worth families and individuals, this more often to not leads to an asset class that has fixed income in it, bonds in it, and it will also lead to a stock portfolio that will have many dividend-paying stocks. This sort of portfolio will admittedly exhibit a meaningful degree of interest rate sensitivity, and one of the big macro threats to these sorts of portfolios is the threat posed by inflation. Commodities in general serve as a hedge against inflation, but within the commodity space, I would argue that none is a better hedge against inflation than gold, and for that reason we think it is prudent to maintain a small portion of gold within clients' portfolios. On balance, we'd argue that gold is a very important component of a well-designed equity portfolio because it serves as an effective inflation hedge and it is such a strong portfolio diversifier. We'd also note that over the long term, we would expect it to continue to trade in the inverse of the US dollar. And finally, in the next edition of Toron Investment Insights, we'll speak to why we think strength in gold stocks should persist throughout 2008 for a whole host of macroeconomic and company-specific reasons.